How to find passive real estate investment opportunities. Most people think passive real estate investing is as easy as writing a check and then starting to get returns, but it's not that easy. In this video, I'll show you how to find the right passive investments for you. The biggest risk in passive investing is not the deal, it's the person running it. Most investors focus too much on the deal and not enough on the sponsor. That could be a costly mistake. The difference between making money in real estate really comes down to one thing: asking the right questions. Stick with me and I'll show you exactly what to look for before you put money in a deal. By the end of this video, you'll know exactly how to vet investment opportunities so you can invest your cash wisely and put your money into long-term opportunities that will create generational wealth without all the headaches of having to manage the investment. So what is passive real estate investing? It's investing in real estate without all the day-to-day headaches. Some examples of this are real estate investment trusts, syndications, partnerships, real estate funds, or crowdfunding platforms. So the number one mistake investors typically make is they focus too much on the deal and not enough on the person running it. The sponsor is critical. A sponsor is the GP or the general partner of the transaction, and then the investors who put up the capital are the limited partners. A great deal with a bad operator could end up being a really bad deal. A mediocre deal with a good operator could end up being a great deal. It's really about who is the person running it. How to vet the sponsor. Number one, track record. What have they done in the past? Have they failed before? Are they willing to admit to their failures? And then what are some of their wins? You want to really evaluate what is the track record of the person running the deal. You want to really evaluate who's the one running the fund, the deal, the partnership, the person that's in charge. Communication. Do they consistently give the investors updates? Are they open and honest about what's going on with the property, with the fund, with the investment opportunity? Communication is critical. Once you make your investment every quarter, that is the expectations we have here at Patriot, that we deliver communications to our investors so they know what's going on. In this communication, there should be financials and a summary of the operations of what's going on with the property. That enough for the investor will help them feel confident that they know what's going on with the property. Some of the key reports for communication are the property and market summary, the financials, and then a statement of their investment. How much was their distribution? What is their capital account? This information will help the investor feel confident that they know what's going on with their investment and hold the sponsor or the lead partner accountable for managing the property or the fund. Next, transparency. Is the general partner or sponsor open about all the risks that are involved? If there is challenges, are they open to disclosing what will be the remedy for that challenge? And if things aren't going to plan, are they going to share exactly how they're going to remedy that and what is the target or the goal to get back on track? This is critical to know that you have someone that's willing to do what it takes and they're focused on fixing the problems rather than hiding them. Number four, skin in the game. So the sponsor typically will work harder if they have their own money or their own credit backing the investment. So find out, anytime you're investing with someone, how much money do you have in the deal? How much of your credit is at stake on this transaction? And I always love to have that alignment of interest with whoever I'm investing with. For me, at my Patriot funds, I always put at least $1 million into each fund. That way the investors know I am committed to this investment with my hard-earned money and my time. Next is evaluating the investment opportunity. You have to pick the right horse and the right jockey. So the right horse is the right investment opportunity. What type of asset class are you investing in this partnership or this fund or this platform? Is it multifamily, affordable housing, Class A housing, office, retail, industrial? There's many different types of commercial real estate assets. At Patriot, we focus on self-storage, manufactured housing, and small bay warehouse. Knowing that the sponsor is experienced in those asset classes is critical, where they're not bouncing around doing 5 or 10 different types of property types. A clear focus is critical for success and an understanding of the geographic area of those assets. In different parts of the country, assets will perform differently. Mobile home communities are different down south than they are up north. Office buildings in core New York are different than in the middle of Oklahoma City. So the general partner needs to know those nuances, and you as the limited partner need to know that they know, so they're going to be successful for that market. Next, risk versus reward. Are the majority of the returns made at the end of the investment, or are they made along the way through cash flow? Or is it a balance of both? It's important to know what are the assumptions at the end of the investment. Many times in real estate investment partnerships or funds, it can be deceiving that you're going to make a high return on investment because of a accelerated exit value. If you're anticipating selling at a low cap rate in 5 years, that's a typical life of a fund, then that will exaggerate the returns because you're getting that big payout at the end. Yet for a more conservative fund, you're looking at cash flow along the way and a conservative number on the exit. In a cash flow driven fund, you are looking at cash flow along the way plus an exit, yet you're not baking in all the returns based on a sale. But it just depends on your investment thesis. Do you want a big appreciation play like a development where you won't have cash flow? Or are you looking at more safety and security and consistent cash flow, but probably not as big of an exit on the back end? It's really up to you, but you need to be clear on the strategy with the partner you're working with. And then lastly, use a checklist to define if the sponsor has all of these things covered. It's important that you ask all of these questions and you make sure you document it or clarify it that these things are covered. If they're not and one thing is unchecked, you might make a bad investment into the wrong property and or the wrong partnership. In the description below, we have a checklist for sponsors. This is an important tool where if you're investing with someone, you can check off the boxes, make sure that your interests are aligned and that the investment strategy fits with your investment focus. So I have a free gift for you, the Essential Guide to Passive Real Estate Investing. These are the 10 keys to successful passive real estate investing. I'm going to share with you all of the things that you should know when getting into a real estate partnership, fund, syndication. It's important that you ask these questions and that you know some of the inside secrets about real estate fundraising and real estate syndication partnerships. If you're looking to invest like a private equity firm, then start thinking like one, and this guide will help you think like a professional so you make the right investments for you. Click on the description below and get your free copy. Thanks.